Ever wondered why price always seems to gravitate towards certain levels, only to reverse right after hitting them? That's not magic. That's liquidity at work. Now you might be asking, but why is price always drawn to liquidity zones? The reason is simple. Now, imagine you have a truckload of food, but you're parked in a lonely area. Of course you won't be able to make much sales, unless you move to a busy area where hungry customers are waiting. That busy area represents a liquidity zone. Same principle applies to the financial markets. If institutional traders want to sell large positions, they need plenty of buyers. That's why price is naturally drawn toward liquidity areas first. After collecting those orders, the market makes its real move. Understanding and marking these liquidity zones on your chart is crucial for making smart and strategic trading decisions. So in this video, we're diving deep into the secret sauce of smart money trading. It's crucial to watch this video till the end because you will have a lot to learn, starting from the impact of liquidity on price action, how to identify and mark out critical liquidity zones on your chart, and how to apply liquidity-based strategies in your trades with real chart examples. If that sounds interesting to you, kindly hit the like button, also subscribe, and turn on the notification bell to stay updated with our latest videos. Now let's get into the video. Liquidity levels are zones on the chart where a large number of orders, like stop losses or pending trades, are typically clustered. These areas tend to attract price, acting like magnets, often just before a significant move takes place. For example, if price pulls back to a certain level, many price action traders might enter long positions and place their stop losses just below it to ride the bullish trend. As price climbs and nears a swing high, other traders may begin taking profits or even entering short trades at resistance. This creates liquidity below swing lows and above swing highs, which are commonly referred to as sell-side and buy-side liquidity. So, liquidity that exists above a high or a group of highs is known as buy-side liquidity. When price nears this area, bearish traders may enter short positions or protect their existing ones. At the same time, breakout traders will go long if the price breaks above this level. This sharp move upward, designed to capture the liquidity above those highs, is called buy-side delivery. It's often a trap set by algorithmic systems to engage both sides of the market before institutional players step in to sell. Conversely, sell-side liquidity is found below a low or group of lows. As price approaches these levels, bullish traders might open new long positions or protect existing ones, while breakout traders could go short if price breaks through. This sharp downward move is known as sell-side delivery, which again tends to trap traders before smart money steps in and drives the price higher toward buy-side targets. Here's a key takeaway. The market typically moves away from areas where liquidity has already been taken and towards areas where liquidity still remains. Now, before we move on to the rest of the video, let's check out the Bitunix crypto exchange, one of the world's most advanced crypto exchanges when it comes to crypto futures trading. They offer the best and the lowest maker and taker fees. You can see all my wins and losses since I started trading with this exchange. If you want to follow my trades, just sign up with this crypto exchange using the link in the description below. And if you want to get in early on any crypto asset, just sign up and start using this Bitunix exchange because they are constantly listing the latest and most verified crypto assets or tokens that are set to explode in this bull run. They offer high standard security and even a huge trading bonus for new users. So, use the link in the description to sign up and start using one of the best crypto exchanges, the Bitunix Crypto Exchange. Now, let's move back to the video. Picture this line chart as a representation of market movements. In a bullish market, sell-side liquidity becomes more significant than buy-side liquidity. This is because when the market dips below recent lows to grab sell-side liquidity, it often sets the stage for a bullish continuation, creating a potential entry point to go long in the direction of the prevailing trend. Now, let's go over the essential types of liquidity you should highlight on your chart. First are swing highs and swing lows. These are terms you've probably heard often, but what do they really mean? Swing points are areas where the price changes direction, forming specific candle patterns. A swing high occurs when price reverses from a significant upward move, while swing lows occurs when price reverses from a significant downward move. You can also use candlestick patterns to identify stronger and more reliable swing points. But to truly grasp why these areas matter, you need to understand the psychology behind them. For example, if a trader wants to buy a currency pair at a certain level, they'll likely place their stop loss just below a recent swing low to protect against sudden market moves. Likewise, if traders plan to sell at a certain level, their stop losses are typically placed just above the swing high. Meanwhile, breakout traders will enter positions if the price breaks through these levels. Based on this, we can identify that buy-side liquidity is located above the high, while sell-side liquidity lies beneath the swing low. So, how can we use this information in our trading? It is very simple. If we have a bullish outlook, the formation of swing lows before the price reaches a demand zone can serve as a strong signal that upward movement is likely to take place. This happens because the market uses those dips to accumulate the necessary liquidity for the next bullish leg. If the market hasn't absorbed enough liquidity, it may fall further to grab more sell-side liquidity before resuming its upward trend. The same idea applies to bearish conditions. If the market is trending down, the formation of swing highs on the way to a supply zone can act as confirmation of a solid trade setup, suggesting the market is preparing for a continued downward move. Now let's look at the second form of liquidity: equal highs and equal lows. As the name implies, these occur when the price creates repeated highs or lows at roughly the same level. These formations, often seen as double or triple tops and bottoms, are viewed by many retail traders as strong reversal points. For instance, when price revisits an area with equal lows, traders commonly expect it to bounce upward and will open long positions, placing their stop losses just below the level. However, as we discussed earlier, smart money targets these stop loss zones to grab liquidity. That's why it's crucial to be patient and wait for this liquidity to be taken before making a move. If there's a demand zone just beneath the equal lows, it's likely that the price will dip below the level, trigger those stop losses, and then surge upward. This is a core concept in smart money trading, letting the market grab liquidity before entering at a more strategic price. The same logic applies in bearish conditions. When the price hits a resistance area and forms equal highs, retail traders often go short, expecting a downward reversal. Their stop losses sit just above that resistance. Smart money may intentionally push price above this level, collect the liquidity from those stop orders, and then reverse the market to continue the bearish trend. Now let's look at how we can integrate the liquidity concept in our trading. As smart money traders, our goal is to enter the market after liquidity has been swept. Let's break this down with a real example. Now, looking at this chart, you can see that the market is clearly in an uptrend, and there's a support level down here that is held firm twice. As price returns to this area, many retail traders anticipate another bounce and open long positions, clustering their stop losses just below the level. Meanwhile, those already in long trades continue to defend their entries. Now, with this in mind, we can clearly tell that a lot of liquidity lies below this level. So where should we look to enter? If we examine the left side of the chart, we spot an order block, which marks a strong demand zone. This makes it a prime area for setting a buy limit order, placing the stop loss just below the zone. Once price sweeps the liquidity and dips into the zone, it reacts exactly as expected, rejecting the zone and moving higher. Let's look at a bearish example. Here on the Bitcoin 15-minute chart, we can see that the market just shifted from bullish to a bearish trend. And up here, we have this resistance level that has held price multiple times. So, as price returns to the resistance, many retail traders anticipate another bounce and open short positions, clustering their stop losses just above the level. Meanwhile, those already in short trades continue to defend their entries. Now, this already tells us that a lot of liquidity lies above this level. So as smart money traders, we spot this order block up here, which marks a strong supply zone. And that's where we would place our sell limit order, placing our stop loss just above the zone. And letting the trade run, you can see how price swept the liquidity, tapped into our zone, and moved in our direction, giving us a winning trade. So that is simply how you can integrate the liquidity concept in your trading for better results. Remember, Real-time trading won't always go perfectly. You'll encounter losses and missed setups, which is why it's critical to stick to your trading plan and manage risk carefully. If you found value in this video, don't forget to hit the like button, also subscribe and turn on the notification bell so you don't miss out on our latest videos.